This video will walk you through the bond problem that I have posted here, and so let's go ahead and get started. I'm going to show you all four requirements, and I've got this picture here again, and what's important to remember and what will likely confuse you from the beginning is that a bond still has two parties, a lender and a borrower, but we've already looked at how the borrower accounts for the bond issuance, and now we're switching hats, and we are going to be the investor or the lender, right? We're Lester over here, and the borrower is on the other side of the transaction. So what does a bond look like when a lender gives money to a borrower and receives all the subsequent benefits and risks that are associated with the contract that they've entered into? So I've got a timeline here for us as well. Each box represents 1 month of the calendar year, and I've got some highlighted. I'll explain that as we go along. So the first thing we're asked to do is to journalize the initial acquisition of the bonds on April 1st. Remember, we're the lender, we're Lester here. So April 1st, right here, is when we acquire the bonds. So when we acquire the bonds, we get something in exchange for giving our cash. So on April 1st, we'll just do the entry right here, we are going to give up our cash. Cash goes down for the amount we have to pay, and in this case, we're told we bought the bonds at their par value. That's another way of saying they sold at face value. It's another way of saying that the interest rate stated on the face of the bonds matches the market rate. So there's no discount and there's no premium. So we have to give up $56,000 of cash to receive this debt investment. And that's exactly what it is. It's an investment. I have some T accounts down here we could just populate if we wanted to follow along. Our assets go down. We have the accounting equation here as well. Remember, we've got to keep that in balance every time we make an entry. And so my assets go down, and in this case an asset increases. It's an investment. So my debt investment goes up by $56,000. So I would debit debt investment for $56,000. And so then, okay, that was this day, right? And so time just goes along, and so 6 months, 1, 2, 3, 4, 5, 6 months pass, and the borrower has to pay us interest now on October 1st. And so we're going to record the interest that we receive. Remember, we're the lender, we're the investor, so we receive cash interest at this point in time, which is October 1st. Now, the amount of cash we receive is the $56,000 face value of the bonds times the 4.5%. But remember, that would give us how much annual interest we would receive. This bond pays interest semi-annually, so we divide that by 2. We get $1,260 every 6 months. So my assets go up, cash goes up by $1,260. I don't have a T account for this next account, but you would credit then interest revenue. And interest revenue is not a balance sheet account. This shows up on the income statement and makes our profit higher. Interest revenue does. So, and that's one reason we invest, right, is to earn profit on the investment vehicle. So we record interest revenue of $1,260. Now what happened then on October 1st, we also sold some of the bonds. We didn't sell all of the bonds. The problem told us that we got rid of $20,000 of the $56,000 outstanding for whatever reason. We didn't want the bonds anymore. We needed the cash to use for our operations or to expand our own business. So at this point in time, we are going to receive cash. The amount of cash we receive isn't necessarily $20,000. Remember, that's the face value of the bond. We would receive that amount if the person we're selling it to believes that the stated rate of interest is also the subsequent market rate, but it's not. And we know this because they tell us the bonds sell at 99. That means we don't get $20,000. We get $20,000 times 0.99 times 99% of that value. So we receive $19,800. But if you look at the debt investments here, notice we didn't sell them all. We sold 20,000 of them. So that $20,000 has to decrease in my debt investment account. Notice you don't take it and decrease it by 19,800 because this, remember, represents the historical cost. Using the historical cost principle, we record the asset at its original cost and then subsequently remove it at its historical cost, which was $20,000. So I'm going to skip a line here, and we're going to reduce the debt investment by $20,000. And so we have a difference of $200. So my cash went down, My debt investments went down, they're both assets, but this $200 becomes a loss on sale of the debt investment. This is an income statement account. And a debit to an income statement account, this is bad, right? A bad guy. A debit is a bad guy. It makes profit go down. A loss on a sale of debt investments is an expense, kind of. It's a loss item. So we have a reduction in our profit in the current year for the $200,000 loss associated with the sale of the debt investment. Okay, great. So we're still right here in the timeline. Now 3 more months passed, and it's the end of the year, and we know at the end of the year we have to create all the required financial statements for the investors. It would be a balance sheet, an income statement, statement of cash flows. And so when we create those financial statements, we have to make sure we have the right amount of interest income. Remember, we're the lender here. In our income statement right now, we only have these 6 months worth of interest income. So if we do nothing with the subsequent 3 months, we are understating our income because we didn't put enough interest revenue. We still owned some of the bonds for 3 months. That means we should record some of the interest revenue in the current accounting period. So we make an adjusting journal entry on December 31st to record that interest revenue. And a debit to a revenue account makes it go up. Or a credit to a revenue account, it represents an increase. So how much? Well, we don't have 56,000 of the bonds anymore. We only owned 36,000 for this 3-month period. So you take 36,000 times the coupon rate times, and so you could say that would be an annual. So if I did this, this would be an annual amount of interest. But we know we don't want an annual because it's only 3 months that passed, not 12. We could divide this by 12, and that would tell us it's $135 for 1 month's worth of interest. I want more than 1 month, I want 3 months. So I take that 135 times 3, and I need to record $405 of interest revenue. And remember, I don't get that cash yet, right? They'll pay me cash according to the terms in the contract, which says April 1st, right here, April 1st and October 1st. So the next payment will happen April 1st, but now, so that means I can't record cash, I record interest receivable. And that is how you would record the accrual of interest at the end of the year.